Podcast. My name is Filip Vukovic, and I'm the head of transfer pricing with KPMG Lower Gulf. I'll be hosting today's session along with my colleagues, who I will introduce to the wider audience in a couple of minutes. I will note that this is our third in the series of webcasts that KPMG Middle East is devoting to economic substance rules, starting from August 2019 to most recently June 2020. In the meanwhile, we were aware of additional efforts which were being undertaken by the UAE authorities on the ESR front. But unfortunately, due to the disruption COVID has created worldwide, amendments to the respective rules were announced only during August-September 2020. The purpose of today's webcast is to share some insight on these recent changes to the rules and the impact they will have on business across the UAE. Next slide, please. I'm joined today by two international tax partners, Nilesh Ashar and Anush Kapoor, who are leading KPMG ESR implementation efforts in the United Arab Emirates, and I couldn't think of anyone more suitable than them to provide us with useful takeaways and hand-on practical examples of the application of the new rules. Next slide, please. Today's agenda is as follows. We will briefly touch base on the background of the events leading to the change in ESR rules, followed by a deep dive into the most important amendments and key takeaways for UAE business operations. As always, we will close the session with a 10-minute Q&A. Next slide, please. Now, before we kick off, just a couple of administration points. In respect to the Q&A, as participant microphones are on mute, we ask of you to use the Q&A button on the right and ask questions as we go along. We do appreciate your feedback and would be grateful if you could complete the short survey at the end of today's session. Finally, the session is being recorded and will be shared with you in the upcoming days. Let's kick off today's session. Next slide, please. Many of you are probably wondering, with good reason, on why ESR regulations is being amended in such short time frame, barely a year after its introduction. Now, as you may know, the UAE is not the only jurisdiction which have introduced such regulations. Namely, a dozen of other jurisdictions, predominantly UK Crown dependencies, along with other countries like Bahrain, have also implemented ESR rules during 2019. Such ESR rules have had certain variations from country to country, and after review by OECD's Forum on Harmful Tax Practices and respective European Union bodies, feedback was communicated to certain jurisdictions, amongst them the United Arab Emirates, on certain improvement points that could be implemented to ensure the harmonization of ESR rules across the globe. We know that these changes have a retroactive effect as of January 2019, and are completely repealing previous rules and guidances. Finally, considering that these rules will be subject to international monitoring through OECD and/or European Union peer reviews, this has also been one of the contributing factors to expand parts of the regulations pertaining to the implementation and, more importantly, the enforcement of the regulation. Now, depending on how these peer reviews progress over time, ESR rules and requirements are expected to evolve dynamically in the future. Next slide, please. As for the key changes in the new rules, they are listed on the slide that you are seeing now, but my observation is that there are four respective main categories that I would like to mention. First, there are changes that impact the scope of the regulation, such as the license and exempted license amendment. Second, there are changes to certain definitions that have an impact on the scope of relevant activities and their interpretation. Third, there are changes in how ESR rules will be administered. And a fourth category for me, which is worth mentioning, is that there are no changes in respect on economic substance rules test requirements. And just as a short reminder, when we're talking about economic substance tests, we're talking about tests pertaining to core income generating activities, management function, adequate resources, and reasonable expenditure that are expected to be incurred in the United Arab Emirates. Now, that said, I would like perhaps to go with the first topic on our discussion. And Nilesh, welcome. Thanks a lot for having the time for today. Could we perhaps dive on the license versus exempted license definition?
Sure. Thanks, Philip, and good morning to everyone. I think one of the most significant changes that has happened in the new regulations is the change in the scope of what is regarded as a licensee for the purposes of the regulations, and importantly, on the scope of the exempted licensee categories. If we go on to the next slide, please. So if you look at the text on your screen, under the old regulations, a licensee included a natural or juridical person that was licensed to carry out an activity. The key difference under the new regulations is that reference to a natural person has been deleted. A licensee now includes only a juridical person, which is clarified to mean a corporate body with separate legal personality, or an unincorporated partnership, whether general partnership, limited partnerships, limited liability partnerships that are registered in the UAE and that carry on a relevant activity in the UAE. Importantly, the clarifications in the FAQ confirm that natural persons, sole proprietorships, trusts, and foundations are not to be regarded as a licensee, and there are a few recent regimes that have introduced foundations and trusts in the United Arab Emirates. Those are notably missing from the definition of a licensee. But I think the more important clarification on this is that while previously there was some uncertainty as to whether you ought to be a licensee first and to be in scope of the regulation, or did you need to actually carry out the relevant activity, I think it's fairly clear now that it does not matter what the license or the trade license says. If you are carrying on a relevant activity, being a juridical person or an unincorporated partnership, you are in scope of the regulations. Then when you look at the exempted licensee category, I think this is the big change that has happened, and this change is more in line with the international rules which some of the other jurisdictions have implemented on ESR, where the government entity exemption, which was previously available under the old regulations, has been withdrawn and has been replaced with a set of 4 key exempted categories, being investment funds, UAE branches of foreign companies, where the relevant income of the UAE branch has been subject to tax in the hands of the parent company, and we'll talk a bit about this in a moment. Then the third category are UAE resident businesses, which are not part of a multinational group, but are owned by UAE citizens or UAE residents that purely operate in the domestic market and are not part of a multinational group. So pure domestic businesses, and understandably so, are eligible for exemption because there would be less potential for base erosion for them to engage in base erosion activities. And then you've got UAE entities where there is which are treated as residents of other jurisdictions other than the UAE by virtue of, let's say, central management and control. Even those are regarded as exempt, and we'll talk a bit through examples. And then there's a fifth category which gives the Ministry of Finance the ability to include any other licensee or category of licensee in an exempted list. One I suspect will develop going forward. If we move on to the next slide, please. I think what this really means to be an exempted licensee, I think it's important to get this right. Exempted licensee does not mean you don't need to do anything. If you are an exempted licensee that carries on a relevant activity, you are still required to file a notification. And along with the notification, sufficient evidence, that's the word the legislation uses, sufficient evidence must be included along with your notification. And some of the guidance on this point refers around where UAE entities are claiming their tax residency to be outside the UAE, either by virtue of central management control, then you include a tax residency certificate or a letter from the tax authority confirming that, or evidence of payments of taxes on all of the corporate income back in the country. And if you're a branch of a foreign company, presumably copy of the income tax return of the foreign parent, which shows that the income of the UAE branch has been subject to tax or reported to tax. And we'll talk a bit about this in a moment, because there is, as you are all aware, in the international tax context, subject to tax is a highly litigative and unclear concept, and there are significant case laws on this point. The second implication of being an exempted licensee is that you're not required to meet the ESR test unless you fail the exemption by virtue of the sufficient documentation criteria. And the third important aspect of being an exempted licensee is that the moment you claim the exemption, Ministry of Finance will exchange the information relating to your exemption with the foreign tax authorities in the country where you claim you are a tax resident, or where the foreign parent is subject to tax on the income of the branch. Next slide, please. Now, if you look at some of the exempted licensees examples, an investment fund is an exempted licensee, and that includes not just the fund itself, and there's an extensive definition of what an investment fund is, but also any SPVs or holding companies set up in the UAE through which the fund invests in the portfolio company. Even those holding companies or SPVs are entitled to the exemption. I think it's the original criteria of a self-managed fund continues under the new regulations. If you're a self-managed investment fund, that will not be entitled to the exemption. But where you have a fund manager separate to the investment fund, the fund will be entitled to the exemption. The second category is where there is a UAE company which is, let's say, centrally managed and controlled by its board that is resident in the UK, for example. Under the UK corporation tax rules, a company is regarded as a UK tax resident where either it's incorporated in the UK or where its central management and control is located in the UK. So to the extent the UAE company's central management control is in the UK, and you can evidence that through a payment of corporation taxes in the UK or a tax residency certificate from HMRC, you should be able to claim that exemption. Of course, central management control on it by itself is a fairly subjective topic. The third category are UAE businesses which are owned by UAE residents, and UAE residents is defined to include UAE citizens as well as non-citizens, but those that are resident in Dubai or in the UAE under a residency visa. And if they purely carry out domestic operations, those types of entities are again entitled to an exemption under the regulations. Next slide, please. Then we look at some of the clarification on branches. I think this is one where there was a fair bit of confusion and uncertainty under the original regulations. In a welcome move, the Ministry of Finance has helpfully clarified the treatment on branches, both UAE and foreign branches. So if you look at pure UAE parent company with UAE branches previously, you had different regulatory authorities taking the view that you need multiple notifications to be filed. The new regulations have clarified that a UAE parent with UAE branches, whether mainland or free zone, should now file a single notification or a single report on its substance requirements. You then have a situation where you have a foreign branch of a UAE company. Now here you need to look at whether that foreign branch is actually subject to tax in the location of the branch. To the extent, so if you look at UAE company with a Saudi branch that typically would pay corporation tax in Saudi, in that case, the activities and the income of the Saudi branch are not to be included in the reporting of the UAE parent. Whereas if the same situation you had a Bahraini branch instead of a Saudi branch, because there is no corporation tax in Bahrain, the activities, the income, and the substance requirements would have to be reported for the Bahrain branch as well. Obviously, the element that's unclear is how do you demonstrate SIGA and adequacy of employees, etc., in the UAE for a branch that's based in Bahrain, and that's something that needs to be worked through to see how best that should be or needs to be reported under the regulations. And then you have a case of a UAE branch of a foreign company. We talked about this. The key criteria to claim the branch exemption is where the income of the UAE branch is subject to tax in the hands of the parent company, and the guidance clarifies that the subject to tax criteria means that the income of the UAE branch must be reported in the tax return of the foreign parent, regardless of whether that income is otherwise entitled to an exemption, both domestic or under a tax treaty. Now, obviously, that's a fairly blanket statement. We need to look at what reported to tax means in the context of the parent company's domestic tax legislation, and whether there's an actual line item in the tax return that needs to include the UAE branch, or does it need to be part of the tax computation, or is otherwise claimed under an exemption with the tax authorities in the parent company. Whereas obviously in the context of a UAE branch of a Bahraini parent, that would not be entitled to the exemption. It will be treated as a separate legal entity for the UAE Economic Substance purposes, because obviously Bahrain does not apply any corporation tax either on domestic or on foreign businesses. So those are the key changes on the scope of the regulations. With that, Philip, I'll hand it back to you to take through the next section.
Just a question. In respect, we were discussing branches, and what about representative offices? I do understand that then it's going to be a more simple kind of analysis to be conducted in this respect.
Yes, I think so. Representative offices, by definition and by license, are generally not permitted to, or generally do not carry on any commercial activities. So, to the extent there is a rep office that does not carry on any commercial activities, we would expect them not to carry on a relevant activity also. And on that basis, they would be outside the scope of should be outside the scope of the regulations.
Perfect. Thanks a lot. Now I see a kind of much broader definition since we started. Exempted license was just the kind of government majority owned companies. Now we have a much more elaborate set of rules. Then in terms of branches, we have much more clarity. And if we go to the next slide, Anush, could you kind of give us an overview of what's happening with the amended definition and what has the new ESR rules brought to us?
Oh, thanks, Bill. Greetings to everybody. Moving on to some more important changes in the definition clauses. I think if we look at the slide on the holding company, and what you tried to present here is what is the new version of the holding company business definition look like? Many of us during the thick and thin of June considered holding company as something which is relative to other activities easier to comprehend and apply. Clearly, there was some room for improvement. Now, interestingly, if you see at the front end of the definition, any reference to the law of the land, it could be implied reference to the common company law for mainland entities or the free trade zone regulations. This reference has been removed, as many of us might have experienced. Many a times these references are in context of alluding towards a majority ownership to qualify as a holding company. With these references going out, clearly even a minority stake and a minority corporate structure would fall within the scope of holding company business. It would be equally interesting to see the classification of something which is very peculiar to the Middle Eastern structures, which is 5149 mainland structures. And now clearly the shareholding of 51% is undeniable. Having said that, there is an absence at times of earning the beneficial income, whether it's in form of dividend or capital gains. And it'll be interesting to see how these structures get classified under the holding company function. A few other clarificatory changes in order to remove any ambiguity. One is to do with the pureness of holding solely holding function and also purely earning a passive dividend or capital gains and no commercial activity. Lastly, just because a holding company function owns or operates a real estate asset which is used to disembark its holding function, it would not create any exception to this classification. It would continue to be classified as a holding company. Moving on to two interesting definition changes. And I say interesting is, I fairly remember a lot of discussions with many of the people on the call today as to how do you really classify a related entity? What do you mean by a connected person? How do you determine what forms a group in absence of a definition of a group? Now, these two definitions, in a way, create a hyperloop of cross-references and it could actually get triggered for minimum 4 of the economic activities. It could trigger your classification or reclassification of a distribution business, services business, even headquarters, or the high risk IP business. And let's understand that why. Now, a connected person definition, very interestingly, makes reference to 3 other definitions, right? It makes reference to a group licensee and an exempt licensee. Now, we already heard what we spoke about, what is licensee versus exempted licensee. If we look at the group definition, which now is distinctly defined under the new law, 2 or more entities would be now considered as part of a group. And this, in a way, alludes towards IFRS, where you would look at the consolidated financial statements. And if an entity finds its place within the consolidation, then it would clearly be forming part of the group. And hence, it could trigger the qualification as in any of the 4 functions. Yet, very clearly, there is some level of gray area as to what happens to those groups which do not consolidate their financial statements. Do you continue to look in spirit to what if IFRS would have applied, or look elsewhere? Does CBCR come into question? And again, for those structures where CBCR revenue thresholds are not qualified, how do you still determine what constitutes a group, and hence whether you fall in scope or out of scope? So this interesting hyperloop, this is very peculiar of when a base level legislation is upgraded and you form these layers of cross references. And it will be very important to understand this reclassification and apply it to your subject matter when you apply the new law to your erstwhile 2019 position. Moving on to the next slide, in the context of a distribution business, and I think in a way these changes, while they appear to be subtle, they clearly increase the scope of distribution business classification. All those borderlining cases, which we as KPMG always thought substance over form, going by the intent of the BEPS action plan, going by the intent of revenues and margins are booked versus what is the location of the value chain, should form part of the ESR law. And now with the removal of importing and storage condition, it's no longer relevant whether the goods were actually imported or not. Yes, it was important in the VAT scope of things, but for ESR, the drop shipment models are very well officially now covered within the legislation. Also, very similar to what the ESR law reads closer to home in case of Bahrain, it is of no significance now whether the goods have been resold or re-exported outside UAE, or it is a local sale. Till the time, as part of carrying on a distribution function, of course, you look at the new definition of connected person. If you qualify, the location of your value chain constituents is no longer relevant. It needs to be a foreign connected person, and you need to be undertaking a distribution business. Similar to this, if we look at the next slide, even in the service center business, now it's no longer of any consequence whether the services provided to a foreign connected person are in connection with the business inside UAE or outside UAE. Again, a very typical borderline case where otherwise you satisfied all other elements of qualifying as a service center business, but just because the services, say you had a common cost center in the UAE providing marketing services to the whole group, and if those services were taken a position that these services are being rendered to a foreign connected person, yes. However, these are not being rendered in connection with the business inside the state, but it's outside the state. Now, no longer, this is no longer a parameter, and simply performing these services to foreign connected persons and booking the revenue and margins with UAE qualifies you as a service center business. Moving on to the next slide. Now, in context of high risk IP, and we all keep high risk IP as at a much higher pedestal, rightly so, because it is exposed to a much higher level of substance governance, much higher level of data disclosure, exchange of information across borders. Now, erstwhile IP business definition had Part A and Part B. Now, while Part A stands as is, with its renewed reference to, again, the connected person and the group. However, Part B, which tend to reflect on the core income generating activities of a typical high risk IP, no longer forms part of the regulation. And I think it will be quite interesting to ask Philip from a transfer pricing perspective. Philip, where do you see this change impacting our audience?
I mean, the change is very interesting because to a certain extent, we still have the DEMPE concept, but only for high-risk IP. So now if you have an IP business which is failing to do some of these things, it is not going to be considered as a high-risk IP by default, but it is just going to fail meeting the kind of SIGA or the ESR test. So I think that this is more aligned with what we observe in other ESR rules across the globe. But it is interesting that DEMPE still is there, but only to a narrower extent for the high-risk IP business, which to a certain extent is logical, as this is where a BEPS opportunity may arise.
And I think one last point which I would tend to raise, fully agreeing with Philip, is one should not confuse the definition of group to the definition of M&E group, which has been used for a very distinct and restricted purpose in context of exempt licenses. So it's very important to keep that distinction and the group definition only to be reflected upon for all these three categories of functions. Over to you, Philip.
Perfect. Thanks a lot, Anuj, for these clarifications on the definitions. Now, Nilesh, I'm just conscious of time, so I'm going to continue shortly. Could you give us an overview of what is happening on the third pillar that I was mentioning, the administration matters of the new ESR rules?
Sure, Philip. So I think the big change that's happened between the old and the new regulations is the inclusion of the FTA in the overall scheme of things. Under the old regulations, it was the regulatory authorities, which was the Ministry of Economy for mainland or the relevant free zone authorities, that had the responsibility not just to collect the notification and the report, but also to conduct the assessments of the substance tests, which is where, if you look at the substance as a concept, it's essentially the tax authorities who are the right administration to be evaluating and assessing substance. So the role of the regulatory authority has been diluted, and rightly so, to collecting the notifications and the reports, being the interface between the licensee and the FTA. Their responsibility has now been diluted to just the basic checking and verification of the notifications and the reports to ensure accuracy and whether the exempted licensee has submitted the appropriate evidence to claim that exemption. But the National Assessing Authority, which is the FTA, will now be responsible for conducting the assessments on the economic substance tests, administering penalties for non-compliance, dealing with any appeals, and also reporting to the Ministry of Finance with regard to licensee that have failed the economic substance test, those that are high-risk IP licensees, and those that are claiming exemption by virtue of being tax resident outside the UAE. And then, of course, as per the original rules, the Ministry of Finance will share that information with tax authorities in the foreign jurisdictions. Next slide, please. As regards some of the other compliance matters, as far as notifications are concerned, it's clear that Ministry of Finance is likely to launch a portal for filing all the notifications and reports online. Presumably, both the Ministry of Finance, the FT, as well as the regulatory authorities will all have access to the portal, along with the users or the businesses. Interestingly, the notifications for 2019 that were already filed on 30th of June 2020, earlier this year, they all have to be refiled. And importantly, refiled under the new law. So some of the classification changes that we discussed earlier on will have to be considered before the refiling takes place. And another helpful clarification is that you now have 6 months from the end of the financial year to submit the notifications going forward. So the December 2020 year-end notifications will be due on 30th of June 2021. As far as the notification of the ESR reporting format is concerned, while we don't have the format yet, it's clear that in the notification, all licensees now need to submit details of the parent company, ultimate parent company, and the ultimate beneficial owner. Whereas previously under the old regulations, It was only the high-risk IP licensee that had to submit this information, but now that this is required for all licensees. And importantly, the ESR report will need to be accompanied with the financial statements. It is unclear whether these are audited financial statements or management prepared financial statements, but they do need to be submitted along with the report. And then you have clarification on licensees that are undergoing liquidation, where even if they carry on a relevant activity during the liquidation process, they do need to continue to meet the tests and right up till the event of liquidation.
Thanks.
Next slide.
I see, yes, the National Assessing Authority, that is a huge news. And I see that we're going to have to redo the compliance to a certain extent for the notification which were already filed. What about penalties? What is the news there?
Yeah, I think there's been an update on the penalties. You can see the revised slightly higher numbers on the penalty. I think the key change for me is that the element of subjectivity on the quantum of penalty, which was between 10 and 50,000 dirhams in the first year, has now been replaced by a flat 50,000 dirham penalty for the first year, 400,000 for the subsequent years. And for any subsequent years, the license annulment criteria as well. And I think the important point to note is that the penalties, the FTA will now have up to 6 years from the end of the relevant financial year to levy a penalty, unless it's in the context of failure to provide an information where there is a 12-month gap. But really, you therefore need to be prepared to demonstrate substance, documentation, etc., for a period of 6 years. In order to mitigate any risk of penalty from the FTA in the event of an audit.
And for all of you which are registered VAT taxpayers, I think that you are quite aware on how serious the FTA does look into enforcement. So it is really going to be a crucial change from my perspective. Well, thanks a lot, Nilesh, for the inputs. Now, if we would go to the next slide, I would ask Anush, having heard these kind of 3 poles of changes and having taken a look into a little bit in depth of what is happening, what would be your message and the key takeaways for business across the UAE to implement and make sure that they are in compliance with the changes of the rules?
Sure, and without sounding a cliche, I think the writing is on the wall. That the changes and the new version of the ESR law has been released very purposefully. I think it's for the businesses now to put this in context and stitch the new law, the new definitions, the new interpretations to their erstwhile positions. Of course, the re-notification compliance applies all across, unless you're not carrying out a relevant activity. And I think it's about time we realize that ESR regulations are not just here to stay, but they'll keep evolving, right? And these changes, getting more meatier, getting into more and more folds, you need to zoom into these changes and really ask the question as to why should I not fall within the scope of this regulation and not the otherwise. The addition of FTA, I think let's not forget that the 4th minimum web standard is actually dispute resolution. And as you rightly mentioned, we all have had the taste of system-generated penalties. I am sure none of us have a taste for it. As far as government entities are concerned, the exemption has been taken away. I think they need to go to square one and really go back to the drawing board. And it's important to understand the difference between what is an exempted entity and what is an out-of-scope entity. As an out-of-scope entity, you're not the target audience, but as an exempted entity, you are the privileged one. And there's no free lunch to earn your privileges. And lastly, as I said, the rules will keep evolving. It's important as we all get busy with our day jobs and our commercials and businesses, we keep a constant tab of what ESR profile means to the group, whether it's an M&A deal, previous UAE structures, new UAE structures, any new business, change in the business model, change in your transfer pricing policy, you will always have a cascading impact on your ESR profile to take note of.
Thanks a lot, Anush. Gentlemen, I think that this was very helpful. And as promised, we left 10 minutes for the Q&A session. We have quite a lot of them. Now, Nilesh, could I ask you one thing? We have a very interesting question is non-fulfillment of the ESR test. Will it have any kind of impact on the tax residence certificate or TDC certificates which are issued by the authorities?
I think this is a very good and a practical question. While the ESR regulations expressly stipulate penalties for non-fulfillment of the tests and exchange of information with tax authorities in the other countries, I see a couple of other related implications to follow, and tax residency certificate, which the Ministry of Finance issues, is clearly one which will be subject to review from an economic substance standpoint. So if you fail the economic substance test, I expect Ministry of Finance to take that into consideration before issuing the tax residency certificate. And the other related implication, Philip, I think that will be there for businesses is how banks will transact with businesses that have failed the economic substance test as part of any KYC requirements or internal policy requirements that banks may have in terms of dealing with licensees or dealing with businesses that do not have substance in the jurisdiction. So I think that's the other element to keep an eye out for. But you're right. I think it could have an impact on TRCs. So Philip, you're on mute. Philip.
I'm sorry, everybody. There was also a kind of a question in respect to what a relevant activity should be and whether we should follow a company trade license, a company business plan, or the actual activities. So Anush, if you would just, I know that you mentioned before substance over form, but if you could just kind of reiterate on how this will be assigned in practice.
Sure, and I believe these kind of questions do come up where you have some sort of a hybrid entity which is doing more than one function. I think the starting point tends to be where you have some sort of downstream investments parked under this UAE structure, but then in addition to that, you end up performing some services, doing some commercial activity. I think what's important in terms of reaching to that conclusion is you go through each definition of the activity and find a reason of whether you are in scope or out of scope. So ultimately, either you will find yourself out of scope of all activities and hence find the reason of falling out of scope of the regulation itself, or you may find yourself in a situation where you might be out of the holding function because, as we said, unless you're earning only purely dividend and capital gains, you will not be classified as holding function. But if the supply of services are triggering the definition persons, etc., then you may fall very well within the scope of service center. So it's kind of a very sequential analysis of each activity in, out, and ultimately drawing the conclusion as a consolidated analysis of each of those steps.
Thanks, Anush. Nilesh, in terms of the timeline of the notification resubmissions for 2019, we had a couple of questions in this respect. Could you give us a kind of input of what we know so far?
Yeah, so the notifications that were filed, so I think businesses ought to be aware the notifications that were filed for on 30th of June or before 30th of June 2019 were in the context of businesses whose financial year ended on 31st of December 2019. So all those notifications that have been filed do need to be refiled under the new rules, and they need to be refiled on the Ministry of Finance portal once that goes live. I think while we don't have the definitive dates, I would expect, towards the end of November, early December, maybe even sooner, for the portal to be live. I'm sure the Ministry of Finance is working at the back end on the portal, because obviously the ESR returns have to also be filed on the portal by 31st of December 2024. For December 2019 financial year. And so the notification will have to be refiled on the portal, along with, there may be additional questions in the notification that will need to be filed. Maybe some documents may have to be uploaded. For example, for exempted licensees, sufficient evidence for claiming the exemption will need to be uploaded. So I would expect some change to the notification format, to the information that needs to be disclosed. The details of ultimate beneficial owner, parent company, and ultimate parent company now has to be submitted for all licensees. So there will be some changes to the notification, but they have to be filed on the portal, and importantly, they have to be filed under the new regulations. So the classifications that may have been adopted in the previous notifications do need to be revisited, certainly for the IP business, the holding business, the distribution service center businesses that we talked about earlier.
Thanks, Nilesh. Anuj, I had a question about lease financing. And there are people kind of asking and wanting to know what is happening with intercompany loans, what is happening with the relevant activities. Can you comment on what do we know as of now?
Sure, and I think this comes through from what we saw in June as under phase 1, where lease financing activities were classified, but for mainland entities, there was a dichotomy as to between MOF and MOE and say a central bank or the SCA, which one is really the relevant authority. I'm afraid this dichotomy still prevails. But one would hope that some of these questions are answered as we continue to see some of the other development. But as of now, the position stands as is. I don't believe there's a question mark or change in the classification unless it is driven with the change in the definition clauses. And hence it will be relevant to conduct your ESR tests based on that lease classification, lease financing classification.
Thanks, Anuj. A question that we also got, perhaps Nilesh, there's a lot of question on what is an investment fund. There's a single family office, an investment fund, there's a sovereign wealth fund, an investment fund. What would be the guidance that we would give to our clients in terms of kind of what is the approach that they need to take and what documents they need to analyze in order to get a clearer picture of that one?
Yeah, I think the investment fund, there is a definition of an investment fund. I mean, I have it in front of me. We can read that. The definition is similar in other legislations in other countries that have introduced economic substance rules. But primarily, investment funds are those entities whose principal business is the issuing of investment interest to third-party investors or pool of investors, to enable the holder of those investors to realize a profit or gain from the investment that an investment fund makes, whether directly or indirectly. And this is similar to the exemption that's been given in other jurisdictions. I would, this is clearly one needs to look at those investment funds, those where third-party funds are pooled together, either for privately held funds or for regulated funds. I would imagine that, when you say private, obviously a bunch of, individuals coming together to set up a company, for example, where you've got multiple shareholders. The question is that an investment fund? I think you need to look at the intent of of that entity. Is it with a view to realize and realize an investment return, or is it to conduct a commercial activity? If it's the former, it can be categorized as an investment fund. But certainly, I think this is one that needs to be looked at based on the charter documents of the entity, the intent for which the entity was set up. What is it? How is it that the entity will realize a commercial value for its shareholders or investors to determine whether or not this would be an investment fund or not.
Thanks a lot, Nilesh. Now, I have a number of additional questions, and one which is going repeatedly is that participants here cannot find the link to the ESR regulations. We will include the links to the respective new rules in our email communication, which will be following this webcast. Now, I'm conscious that there is a kind of a number of questions that we are not managing to cover. Perhaps let's go on for another 5 minutes to try to cover as much as we can. Now, Anuj, I had a question in a classification of service center versus representative office, and whether if there is a mismatch between the activity and the license, do we have to do kind of change the license type, and what needs to be done? You're on mute, Anush.
Sorry, still learning. I think I'm that in a way that the remedial steps you need to take as part of the impact of ESR needs to come in consonance with the problem. Now, if you look at the licensee definition, we very well mentioned that it no longer clearly just reflects upon what your license is. And then when you look at the definition clauses, and if the argument is very clear that you fall under service center, then irrespective of what your license is of a rep office, which should not ideally be doing any commercial activity, you will still have to go ahead and file your ESR notification and your substance test based on the application of service center definition. And yes, as in terms of a hygiene step, by all means, since you no longer fall within the very restrictive remit of a rep office, by all means, there should be a valid argument of changing that license and upgrading it to what it ideally should be, driven by your substance and not just form.
Thank you, Anush. Nilesh, I had a question here, which was a specific one. It says, in case of entities registered in the UAE but are being taxed on their income in other jurisdictions, does this kind of fall within the exemption criteria that you were mentioning previously?
So the short answer is no. If a UAE entity pays any taxes on income that's earned from sources in other jurisdictions by virtue of, say, withholding tax, and then even though that income is subject to tax in that jurisdiction by virtue of withholding tax, the UAE entity on that account itself will not be entitled to the exemption, because in order to be entitled to that exemption, the UAE entity needs to be subject to tax on all of its income in another jurisdiction. So in this case, it will not be entitled to the exemption.
Thanks. And there is a question, although it's not clear, it says, is it applicable, are ESR rules applicable to SPVs? Now, I would assume that it depends on what kind of SPV it is, but perhaps if you could just share some light to the wider audience.
Yeah, so I mean, SPVs is a loosely used term, right? SPVs could mean different things to different people. But if you have an SPV of an investment fund, so if you have a fund that sets up an SPV to make the investment in the portfolio company, then provided it's an investment fund that has set up the SPV, then the SPV also is entitled to the exemption. But on its own, an SPV that takes on a holding function role, which invests in equity interests and earns dividend and gains, those types of SPVs will likely be regarded as holding companies and not entitled to the exemption. So when you look at what the SPV actually does, as opposed to a loosely applied classification to an SPV.
Perfect. Well, I think that said, we said that we're going to continue it for 5 minutes. I think that we're going to close the Q&A session for now. We have the questions, and if there are any that were not answered, I'm sure that Nilesh, Anush, myself, and the team will get in touch with you shortly. I just wanted to kind of bring your attention on how KPMG does assist UAE businesses and what's the way forward from kind of our perspective. Because as the deadline previously was 30th of June, we would assume that everybody did the assessment of ESR and submitted notifications. Now we think that there is a need to reassess whether you are in scope of the ESR as per the new rules, whether you are a licensee exempted license, and to ascertain the relevant activities based on the revised definitions. Now, the phase 2 is what we call a gap analysis, where we identify the gaps between the existing substance and the level of economic substance required under the regulations. Now, we would suppose that the majority of people here on the call are currently undergoing these activities. Now, it has to be done through the new lenses to see whether there is any remedial action that needs to be done. And the third one is the compliance assistance on when the portal comes live and when the ESR reporting package is announced, that there's going to be another round of compliance obligation to be done. and not to mention the re-notification, which will have to be done even before that. Is there anything that I'm forgetting, Nilesh, Anush?
No, not really. I think you've covered it well. I think the key, as you rightly pointed out, is to focus really on the existing level of substance. And while you would be looking at this for 2019 so that you can report it in the 2020 returns, I think the important part of the substance testing is also to ensure that you put in place a framework to operate going forward in a manner that is in compliance with the regulations, because the ESR is an annual requirement, both in terms of notification and reporting. So, importantly, to look at how you operated in 2019, but more importantly, how are you going to operate going forward under the substance rules?
Perfect. Well, thank you, everybody. Thank you, Nilesh. Thank you, Anush, for providing this insight. I want to thank to all of our participants for being here and bearing with us. This is not the only webinar that we are envisaging. I think that as the year-end period comes and as we have more clarifications and more positions, I'm sure that we will come back to you with additional information. Any questions that you might have, you will see the email coming, our contact details, so feel free to reach out. This is why we are here. Thank you, everybody, and
thank you, everybody.
A pleasant afternoon. Please do not forget the survey. That would be very, very useful for us to improve in the future. Thank you. Bye-bye.